Good morning, everyone. Thanks for joining us today. As we all know, the webinar is going to be about corporate bonds and government securities and where the investors should focus. To explain why we're doing this webinar, there have been a few questions from the investors regarding the better avenue for investment. Like, is it safe to invest in either of these? Do they actually provide a regular source of income? Which is actually beneficial for an investor. So to answer all your questions and to provide a brief overview of these two securities instruments, we are doing this webinar. So moving on, next slide, the next one, sorry. We'll first examine the risk return profile of corporate bonds and government securities. When we look at the returns, corporate bonds offer higher returns compared to government securities, which offer lower returns. This can be correlated with the credit risk of the securities. While government securities come with minimal to no risk, corporate bonds come with varying degrees of credit risk. For example, a corporate bond rated AAA carries lesser risk, while a corporate bond rated, let's say, a B, carries a high amount of credit risk. So, to compensate the investors for the risk they take, the borrowers offer high returns compared to the investment grade bonds. As we keep going down on the credit rating scale, the returns go up. Next, when we consider interest rate risk, it is low for corporate bonds and varies for government securities. The main reason for this being the maturity of the instruments. Corporate bonds usually have shorter maturities, and so they are less sensitive to interest rate changes. But when we look at government securities, a government bond with shorter maturity is less sensitive to changes in interest rates as it is paid off sooner. But a GSEC bond with a longer maturity is more sensitive to interest rate changes. Next, coming to inflation risk, corporate bonds carry moderate inflation risk as companies can adjust to inflation through price increases or cost management. Government securities, especially the long term ones, have higher inflation risk due to their fixed payments and limited flexibility in responding to inflation. Rising inflation typically leads to higher interest rates, hurting the prices of G-SECs more than corporate bonds. So the corporate bonds with floating interest, floating rates, or shorter duration are less impacted by inflation. G-SECs are generally more exposed to inflation risk than corporate bonds. Lastly, liquidity risk is moderate to high for corporate bonds because they're generally less traded than government securities, especially for bonds from smaller companies or in niche markets. If investors want to sell at a discount due to lower demand, or if investors want to sell corporate bonds quickly, they may face difficulties or sell at a discount due to lower demand or a smaller pool of buyers. Government securities, on the other hand, are highly liquid because they are backed by the government, have deep and active markets, and are traded in large volumes. G6 are generally more accessible to a broad range of investors, ensuring ease of buying and selling with minimal price impact. Therefore, liquidity risk for G6 is low compared to corporate bonds. Sorry, am I properly audible? I think my voice. Uh, okay, thank you.
Yeah, you're audible.
Okay, thank you, sir. Next slide, please. Yeah. So now that we've seen the risks that the two securities entail, we'll discuss the sources of these two risks. So next slide, please. Yeah. So when we look at the government securities and corporate bonds, they all come with their own risks. And now we look at the sources of these two risks. Sorry, a minute. Yeah. Uh, when we look at government securities, interest rate cycle is a huge source of risk. Government securities are highly sensitive to changes in the interest rate cycle. When interest rates rise, the value of existing GSEC falls because newer bonds offer higher yields, making older bonds less attractive. This is particularly true for long duration GSECs, which experience greater price volatility in response to rate changes. Investors holding these securities may face capital losses if they need to sell before maturity. So, therefore, the interest rate cycle can pose significant risk to government securities, especially in rising rate environments. Next source of risk is the fiscal management part. So the fiscal management of a government plays a key role in the risk associated with government securities. If a government faces budget deficits or high debt levels or poor fiscal policies, it might struggle to meet its debt obligations or resort to excessive borrowing. This can lead to inflation, currency devaluation, or a loss of investor confidence. While governments typically have low default risk, poor fiscal management can undermine their ability to honor debt payments, making government securities riskier, especially in emerging markets or during periods of fiscal management. Next, we'll look at market depth. So, the market depth of government securities refers to how liquid and active the bond market is. So, in countries with shallow bond markets or limited investor participation, even small shifts in supply or demand can lead to significant price volatility. And additionally, government securities in emerging markets may face higher liquidity risk compared to those in developed economies where markets are larger and more established. A lack of market depth increases the risk of price fluctuations, making it harder for investors to buy or sell the government securities without significantly impacting their price. So when we look at the sources of risk to corporate bonds, there'll be credit cycle, balance sheets, and liquidity, and we'll look at them one by one. So when we consider credit cycle, so corporate bonds are not sensitive to interest rate risk as much as they are sensitive to credit cycle risk. They're actually more prone to credit cycle risk. The credit cycle significantly impacts corporate bonds as it reflects the broader economic environment and the financial health of companies. During economic downturns, companies may face reduced revenues and higher borrowing costs, which can strain their ability to meet debt obligations, increasing default risk. Conversely, in a positive credit cycle, companies may actually benefit from lower borrowing costs and improve cash flow. However, in a tightening credit cycle, corporate bonds may experience higher yields and lower prices as investors demand more compensation for increased risk, particularly from lower rated issuers. And when we look at balance sheets as a source of risk, the strength of a corporation's balance sheet is actually a key determinant of risk for corporate bonds. A company with, say, high debt levels or weak cash flows or low profitability is more vulnerable to economic shocks and may struggle to service its debt, increasing the risk of default. On the other hand, a healthy balance sheet with strong liquidity, solid earnings, and manageable debt levels lowers credit risk. If a company's financial condition worsens, its bonds may downgrade, leading to higher yields and lower bond prices as investors price in the increased risk of non-payment. So next we'll look at liquidity. Liquidity risk for corporate bonds arises from the fact that these bonds may not trade as frequently or in as large volumes as government securities, especially for smaller issuers or bonds with lower credit ratings. During periods of market stress, corporate bonds can become actually harder to sell without affecting their price, particularly if there is a lack of institutional buyers. Lower liquidity means investors may have to accept a discount when selling corporate bonds or face higher bid ask spreads. For bonds with weaker credit ratings, liquidity risk is even more pronounced, potentially leading to significant price volatility. Also, if you feel that you can, also if you think that you can sell the bond with a very minimal or no exit load, this is not possible for direct bond holdings. In that case, debt mutual funds are preferred as they offer both liquidity and market depth. So the essential takeaway is that next slide, please. So the essential takeaway is that the investors should be aware of the risks that they would be taking on while investing in these securities and to know where they actually lie on the tolerance band. When you look at the scale, a conservative investor might be more comfortable with government securities compared to an aggressive investor who would prefer, riskier investments like the corporate bonds. So the conservative investor could look at, say, a low duration government bond, whereas an aggressive investor might feel that a long duration government bond or corporate bonds are right up their alley. The next, Samyukta will continue.
Thanks, Vaishnavi. Can we move to part two? I think the slide is still stuck. All right. So let's look at the second section of the webinar, which is about changing narratives in 2024. So we wanted to look at how the market has actually shifted in this time frame to a different story where we have to relook at the way that we are viewing fixed income investment opportunities. Next slide, please. So one way to look at this is actually to look at the yield story that we've had. So we have data from the start of the year till somewhere in the middle of November. And the basic idea is that yields across the board, right? So whether it's your AAA PSUs, whether it's your AAA NBFCs, or if it's the government securities, have actually come down. And this is so why has this happened? On one front, I think you're seeing better economic growth. You're seeing a lot of these outcomes which are actually positive. On the second side, we've had a flat yield curve, and we knew that somewhere either the long end or the short end of the curve actually had to react so that we normalize. And what has happened? So these are all the 10-year yields, right, of these bonds. And what has essentially happened is that you had a rally, that is, your yields have actually come down, which in fixed income actually is a good thing because when your yields reduce, you have you make profits out of the bonds that you own. So if we look at the level of returns and if we look at the level of changes that we're seeing here, you will notice that the brown line is essentially your government bond curve, right? And you've had uh, rates come down from roughly about 7.25% to almost 6.9%, which is where we are today. And that translates into, say, like a 3.5% return on that investment. At the same time, we've had PSU bonds actually had the biggest rally, where yields were upwards of 8% at the start of the year, and now they're trading slightly below 7.5%. So there's been almost a 5% mark to market kind of gain in yields. And then when we look at the NBFC side, I think the NBFCs have had a much more volatile year. And I think if you've been paying attention to what the RBI is saying, the kind of oversight they've had, the way that they've tried to regulate um, a lot of activity in that sector, there has actually been a lot more going on there, and the mark to market gains are not as pronounced. It's roughly about 3%, and your yields have been quite volatile. So, if you look at this particular segment, you're actually seeing that you start more or less the yields haven't come down. It's been around 8% for most part of the year, and towards the end only we've seen some kind of rally. And I think in the latest monetary policy statement also, it seemed that whatever regulatory actions the RBI has taken has more or less been on a proactive side, in the sense that they wanted to intervene before there was an issue rather than at the time of certain problems. Right? So we can move to the next slide. All right. So I'd like to quickly walk over the monetary policy um, meeting that happened earlier this week, primarily because there's a lot that has changed, and this was an important as well as the final policy for this calendar year. And it also comes in the context of how other central banks have actually been cutting interest rates, and India has a lot to sort of rethink, right? So the metaphor that the governor has been using is about a horse and in the stable. So first you had the elephant, uh, then you had the horse, and this time he said, and the horse essentially refers to inflation, right? Um, and so, because what he's trying to say is that the horse has basically tried to make a very valiant effort to leave the stable, and that the central bank has been kind of ahead of the curve in curbing that action and actually bringing the horse back into the stable. So, the basic thing here is, at the backdrop of the fact that our September and October inflation prints were extremely high, it was expected that these numbers would be higher than the prints that we saw in the previous quarters. But even given those kind of expectations, this number is, sorry, let me just turn on it. Even given those expectations, this number is sort of well above what the RBI was expecting. The basic thing being, of course, that you thought that inflation would be higher because of the base effects, but the real issue has been in food inflation, and that hasn't played out as expected. So now, what the RBI is saying is that they need more credible evidence that things are going to happen the way that they are expecting, and that the direction as well as the development of evolving conditions and the outlook has to go the way that they're projecting. So a lot of this policy was about getting the right actions in at the right time, and uh, what they feel is that it's not yet the right time uh, to sort of look at, it's not the right time for us to look at a rate cut, primarily because inflation is out of control. At the same time, we've also had 1 quarter of growth numbers that have come in, which are well away from the previous projections, right? So we'll move on to the next slide where you can actually see this data between, say, October and December. What was the difference in projections? And here you see that growth is significantly slowing down, right? So in October, of course, we had Q1 data, and Q1 data showed that the economy grew at 6.7%. But in October, the expectation was that Q2 numbers would come in at 7%. And the actual Q2 numbers that have come in now show us that the economy actually only grew at 5.4%. So that's a huge, huge sort of difference in expectation, right? You're seeing almost 1.6% difference in what you projected as your growth number versus what you actually realized. So there is definitely a significant slowdown that has happened in Q2. The question about this is this cyclical? Is this seasonal? Is it a one-off event, or is it something that shows um, more? I mean, is it something that we should be more concerned about? And if we pay closer attention to the RBI's commentary on what caused the slowdown, they're very clear that it was largely just a few segments in the manufacturing space that have contributed to this slowdown number. So there's been lower demand in electricity, there's been lower demand in metals and mining. So there are few sectors that they have labeled as key areas where there was a growth slowdown. But when we look at this difference, I think as investors, we need to be prepared for a situation where this slowdown is more prolonged and it's not only indicative of a few sectors. The second thing, if we look at, is that it's not just Q2 projections that got revised, right? It's your Q3, Q4, and even the projections for 2025, 2026 have undergone some revisions. And if you look at the overall difference, we were expecting, of course, 7.2% was a very optimistic estimate. Perhaps even if we were at 7%, it would have been all right. But if we look at where India is going to land up at the end of the year, it's only 6.6%, which brings us to a situation where we have to rethink not just our fixed income allocations, but even our equity allocations. So we need to sort of come back to the drawing board and look at how we value businesses, how we've expected revenue growth to occur, what our margin expansions are going to be like. Because when we look at the inflation numbers as well, you'll see that there are certain revisions on that side. And when we revise our expectations from equity, it again brings us to a spot where we need to look at the relative merits of fixed income and equity and then make our allocation decisions. Next slide, please, where we can look at the inflation data. So if we look at how inflation is picking up, again, sorry, I think the final inflation number is 4.8 and not 4.6, I mean 6.6. So please ignore that mistake. But essentially, your Q1 numbers were high. You were at 4.9%. Your Q2 numbers again turned out to be higher than what was expected. So Q2 has actually been a quarter where you've seen higher than expected inflation and lower than expected growth, right? So again, in the press conference yesterday for the RBI meeting, there was a lot of questions on, are we going to see a situation where we're in stagflation, where you have low economic activity and high inflation. I don't think we're really there yet, because 4.25 is not concerning in terms of a level of inflation. What is sort of the area of contention is the fact that you expected inflation to be lower and it has been higher. And when we look at Q3, now the revision, because your September, October data essentially shows that you're going to have higher inflation, you have a lower base effect, your monsoon normalizing for the Rabi season is only going to kick in Q4, right? You're not actually going to see that come into Q3. So this set of numbers is going to be much higher, and it's not again a small amount. You're looking at almost a 1% difference in your projection between the two policy meetings, right? So clearly Q3 is also going to be a much more challenging quarter for us to navigate from an inflation perspective. And then I think again the forward expectations from Q3 onwards have actually been revised again, but you're on a wicket where you're seeing more normalization. Now, of course, when we look at where we are in terms of inflation today versus where we've been historically, these numbers are not large, right? So for us to see 5% inflation is actually not that shocking. But the most important thing is that in this era, we have actually shifted to an inflation targeting system, right? So the RBI has a very clear mandate to keep inflation between 2 and 6%, and the long term average needs to trend towards 4%. Now, we've not been successful in getting to 4% as a long term average. In part, this is because we had a slowdown, we had COVID, then you had your inflationary cycle post COVID, and the global environment has been quite uncertain, and there's been a lot of chaos around that side. But what can happen is that we definitely do have space to move towards a more normal inflation trajectory, and that is something the RBI is clearly prioritizing. So the takeaway from this month's meeting was the RBI is focused on growth, right? Because essentially the policy action that they took while they're maintaining their policy stance at neutral and they've not cut interest rates, what they had done is infuse liquidity of about 1 lakh crore into the system by cutting the cash reserve ratio. So the cash reserve ratio was actually increased um, in April 2022, and now they're normalizing it to 4%. And this will happen in two phases, one next week on December 14th, and then the final uh, reduction will happen by the end of the month on December 28th. So by infusing liquidity into the system in a period where they feel that liquidity will become tighter, right, due to say advanced tax payments, GST payments, and then this phase where they're able to infuse more liquidity into the system would actually encourage some lending and investment activity, which they have pointed out as the basic problem in terms of what has caused you to now like a slowdown in Q2 is that from the demand side, there's not been much investment activity. And from the supply side, there are constraints in terms of funding. So, by taking care of these two things, right, to sort of push the manufacturing sector, to push investment activity, is what could bring us back on track. So, these numbers are just projections, and projections are a way for us to sort of indicate where the economy is going. We can't really depend on the projection numbers to formulate a full investment thesis. It's just a directional guidance, and we need to course correct. I think where we are today is a little bit more challenging, and we do need to go, say, from policy to sort of figure out where we're heading, and we won't be able to really look too far into the future. We can move to the next slide. So here, what this tells us is that sentiment is actually shifting, and how is this evident, right? So one is you have markets which are weakening. We've had a rally for the last 5 or 6 trading sessions, so you have seen markets rally this month. But ideally, through November, it was a very volatile month, and you are seeing some level of FII buying increase after a period of heavy selling. But at the same time, there is this adjustment that has to happen in terms of where our growth trajectory is. And when that happens, market sentiment will actually weaken a little bit. And if we do see, if Q2 turns out not to be a one off situation and something that is a little bit more concerning and more prolonged, then we will start seeing slower growth. And when that happens, markets will be volatile, uh, and investors might want to move out of an asset class that has a more uncertain return profile to an asset class that offers more stability. So there will be this return to fixed income that occurs at this point in the cycle, and we feel that this is an important juncture for us to have this conversation with investors, because we have been talking about fixed income through 2024, primarily driven by the fact that India's fiscal discipline is much better. We're getting a lot of global attention. There's been an inclusion into global bond indices. at the same time, the government has followed this path of fiscal consolidation. Our finances are improving. Our external obligations have actually been very well managed. So all of this is happening. Fundamentally, we've been on a good growth wicket. 6.6% is not a bad number. It's not the best number, but it's definitely not something where you should be concerned about not growing. So, given all of these things, uh, we have been very vocal about participating in fixed income in some capacity or the other, right? And I think the early bird always gets the worm, right? So there is a return to fixed income that can happen for investors today, and we'll talk about that. Next slide, please. So when we're talking about the return to fixed income, we actually need to look at how we can get this allocation right. Next slide, please. Vaishnavi, do you want to take this?
Yeah, sure. So, when we look at the importance of prioritizing fixed income in your portfolio, we'll for example we'll take up this nifty TRI data for negative rolling returns. So this graph shows you the percentage of times the rolling returns have been negative. When we consider 1 year returns, they have been negative for roughly about 23% of the time. So that will be about uh, once in 4 times. So in 4 times, once your rolling returns would have been negative. And as we move on, the rolling returns for 2 year returns have been negative for about 16% of the time. And 3 year returns have been negative for about roughly 5% of the time. And for 4 year returns, it is 1.5 percentage. And for 5 year, it is 0.1 percentage. And beyond 5 years, we don't have any historical data explaining negative rolling returns. So when you look at this, it becomes important how uh, it becomes important to take note of uh, the necessity to include fixed income in your portfolio. And this so you can use fixed income as the source of returns to hedge your portfolio, as the fixed income instruments do not carry a similar amount of risk. And this will also help you balance out the returns in your portfolio on a yearly basis so you don't make a huge amount of negative returns. So, next slide, please. When you move on to the benefits derived from corporate and government securities, when we'll first look at stability and risk reduction. So debt securities, particularly government and high quality corporate bonds, are considered safer investments because they provide fixed payments and are less volatile than stocks. So this ability helps reduce overall portfolio risk, especially in uncertain markets. They act as a buffer during equity market downturns, offering more predictable performance. So when you look at portfolio diversification as a benefit, so including debt securities in a portfolio helps achieve diversification as they tend to move differently from stocks and other assets. So this reduces the overall risk of the portfolio because bonds often perform better when stocks are struggling, balancing the impact of market fluctuations. So this lowers the overall portfolio volatility. And debt securities pay fixed interest, or the coupons, at regular intervals, providing investors with consistent and predictable income. So, when an investor gets a regular income from the investment they make, this makes the instruments attractive for income focused investors, such as retirees who depend on steady cash flows for living expenses. The fixed payment structure ensures regular returns for the investors. And when we look at predictable returns, while they are not fully predictable, the returns are predictable to an extent. So as they have set interest payments and a defined maturity date. So if the instruments are held to maturity, the investor knows the exact amount they will receive in interest and principal, barring any default. This predictability helps in planning financial goals. So, coming to liquidity management, debt securities can be easily bought or sold in financial markets, allowing investors to manage liquidity needs effectively. Short-term bonds, in particular, offer flexibility if cash is needed quickly, while longer-term bonds can provide stable cash flows. So, this flexibility helps balance the need for liquidity with investment returns. So last, when we look at hedging against deflation, so when there are deflationary environments, so where prices and wages fall, debt securities can be a useful hedge. The fixed interest payments remain stable even if the value of money increases, ensuring the real value of bond return rises in a deflationary economy. Bonds offer a safeguard against declining prices and economic slowdowns. Oh, next slide, please. So when investing in bonds, so the main thing is that we can't expect to make high returns and regular income, and also avail the benefit of tax efficiency and flexible timelines all in the same go. So there must be a sort of a trade-off on the part of the investors. Suppose if there is any, if you are making any investments, let's say, which offers you high returns and also regular income, it might not have any flexible timelines. And if we consider for an example, if you want regular income and flexibility in your payments, one can consider the SWP route. And for an investor, if you're as an investor, if you're looking for tax efficiency and also flexible timelines, we think alternate investment funds will be a better route. So at some point, the investor has to make a trade-off to avail two or more benefits over the other. Next slide, please. Yeah, when we look at investment options, so we'll consider bank fixed deposits, corporate fixed deposits, bonds, debt mutual funds, and alternate investment funds. When you look at bank fixed deposits, you'll get a fixed amount of interest, but there you get no liquidity as there will be a lock-in period for a bank fixed deposit, and you cannot take out the money without paying the penalties. Also, the you cannot realize any mark-to-market gains or losses, as there will be no valuation that offers you that benefit. And since this is a bank FD, there will be no sort of any credit risk. So when we consider corporate FDs, similar to bank FDs, here also we'll be getting fixed interest payments. But this similar to bank FDs, there is no liquidity available for the people, uh, and there is no mark to market gains or losses possible as well. But this carries a limited amount of credit risk, as there is a possibility that the borrowers, that is the corporate, can default on their payments. So when you consider bonds do offer you a regular uh, interest income, which could be monthly or quarterly or annual payments, and so the bonds do carry a credit risk, as similarly they do. There is a possibility that the borrowers might default and may not pay you the income they're supposed to, and the liquidity will be limited for bonds. So in some there will be a exit load for a particular amount of time that an investor has to pay if they're selling the bond. And when you consider mark to market gains or losses, the bonds will be valued at the current price. So there is a possibility of the investors realizing mark to market gains or losses. When we consider debt mutual funds and alternate investment funds, neither offer interest income, as they are unit based funds, and these do give you mark to market gains or losses, while credit risk is limited in debt mutual funds. Alternate investment funds do carry a definite amount of credit risk. And when you liquidity, a lot of debt mutual funds come with no exit load, but in alternate investment funds, almost all funds come with a percentage of exit load, which makes it difficult for the investors to readily convert their investment into cash. Next slide, please. Right now, when we look at asset allocation in portfolios, we are very positive on precious metals and fixed income. But and while we consider cash holdings and arbitrage, we're neutral about it. And when you go to domestic and global equities, considering the markets right now, we are not very positive on the equities side. So we feel that right now allocating towards precious metals and fixed income will be a very good opportunity for you as an investor. Uh, Samyuktha, can you continue?
Thanks, Vaishnavi. So coming back to this, right, if we look at what our overall view on asset allocation is like today, we are quite positive on the precious metal space. We are quite positive on fixed income. Broadly because, like I mentioned, from a thematic perspective, we think that in an environment where there's a lot of global uncertainty, where there's a lot of geopolitical tensions, precious metals can tend to do really well in such an environment. At the same time, we are at an interest rate cycle near the peak, where your yields have kind of peaked out. You are also looking at India as an economy where, uh, from a macroeconomic perspective, we are still on a very good wicket. Yes, there is some weakening in macro data, but still not bad in that sense. And in an environment where markets have performed really well, economy is slowing down, and there's a divergence between the market reality as well as the ground economic reality, there has to be some shift in asset allocation preferences. And this brings us to why we think these two are strong wealth creators for an investor who's participating today in markets. Where we are neutral is in terms of cash as well as arbitrage. So the reason why we're neutral on cash is primarily because there is this divergence, right? Meaning you're seeing certain indicators which would encourage you to participate outside of the markets. Yet at the same time, markets are still rallying. So there is a sort of opportunity cost if you're going to sit just in cash. Arbitrage, what we've noticed in the last few months is that the yields have been quite volatile. So an investor actually has to track and monitor the yields before they participate in that category. So participating when yields are higher is better than when it's more narrow. And also given how volatile and uncertain the equity markets have been, it's a little bit difficult to sort of look at an all-time or arbitrage is like an all-weather solution. So in today's context, we do feel valuations across the board, whether you're talking about India or in the globe, are a little stretched. There are very few pockets where valuations are comfortable. And so on balance, we would feel that there is a need to revisit the quality of our investment portfolios on the equity side. Next slide, please. So, just a quick overview of Milestones to Wealth and how we can help you participate in the right investments at the right time. Next slide, please. So, about M2W and finesse. So the program is basically to work with every investor to take them from wherever they are to their first crore in financial savings. And our promise in this journey is that we will handhold you through this process. It can be tricky. It's not a 1 year goal. This is something that takes time. For some of you, it can happen in 5 years. For some people, it can happen in 10 years. For others, it might be even longer than that. And we are there to handhold and guide you through this entire journey because it's not something that you can achieve overnight. It is something that requires a lot of planning. It is something that requires a lot of decision making. It is something that requires us to adjust our behavior, uh, have a better mentality when it comes to achieving goals. And in that process, there is also a requirement for some technical knowledge like what we've shared with you today. So we have this strong initiative of Learning Saturdays where at least 3 to 4 hours there are different team members who are sitting down with investors and having productive conversations about how you can create wealth. And this journey requires some coaching and motivation. I think next year will be a year where you'll see a lot of effort from our side in working with you because we know that when it becomes a tougher year in the markets, investors do need to be able to see their end goal and not just what is happening in their portfolios on a day-to-day basis. And at the same time, when markets are not performing, there is still a way to measure what we're doing and to ensure that we're doing the right things at the right time. So this is our promise in terms of what we'll do as M2W. And this can be measured with the outcome, which is that you will see as you enroll into M2W that there is a much higher level of financial discipline that you have. You also will develop a more growth mindset, which means you'll be able to tackle the challenges that come in your finances. And when you're able to do it with your money, you're going to be able to do it with life. So it's not just about what we are doing in this program. The lessons are broadly applicable to every aspect of your life. We will help you build investment connection, which means that if you're with us for a cycle, you'll actually see how things work. You'll become a better investor. You'll be able to do more with your wealth. And we will give you a wealth map, which shows you where you are. It's a comprehensive overview of your finances. So in terms of what kind of investments you need, what kind of insurance you need, how you can work on your credit, some best practices in terms of managing your money and your savings. All of this would be part of the wealth map. And finally, we'll teach you to scale, right? Many of us have never been told in our lives that we can save 1 crore in our working years. Many of us didn't know that that was a possibility. And with when we are able to cross this milestone, right, this process itself is broken up into many stages and steps. And when you reach your first crore, you can actually set much bigger milestones for yourself and go grow from there. This is 1 crore is just another milestone in this journey, but it is the goal that we want to take investors to. So this is the outcome that you can expect. If you are interested in Milestones to Wealth, Gopi will drop the link to the M2W form. Please enroll and have a conversation with our team. And now we'll open up to the next slide. Next slide, please. All right, so we can take Q&A. I think we've reached the end of our presentation. And I already see one question in the Q&A box, so I would like to take that first. So it says that while I thought has been talking a lot about opportunities in debt through finesse over the years, why is it that we don't offer any debt product like a debt PMS? Why is it that you're not openly facilitating buying bonds on the secondary market? There is no regular note on debt MF investments too. I've been with iThought for more than 2 years, and this is based on my personal experience. When we ask about it with the RM, the narrative is that debt is not attractive considering the current tax laws. Um, So I would actually like to answer this question. We do a lot for investors on the fixed income side. Yes, we do not have a pure debt product like a PMS, primarily because most of the investors that we're working with on the fixed income side tend to have smaller corpuses. Debt is only like one part of their portfolio. If we had a product like a PMS, then the minimum investment would be close to 50 lakhs. But we have been offering bonds in the secondary market. If that is not something that you have received, we will work on that and ensure that you're able to have access to that. We also publish an outlook on our blog every month as to what we think is happening in the fixed income space with an overview of the investment strategy. So this is knowledge for everyone who's here in the webinar today. So you can check out our blog on ithought.co.in. We do these webinars also to have conversations on fixed income. If you would like to make an investment, then 100% you can reach us on WhatsApp. Uh, you would have our central numbers and automatically we'll take this forward. I'm sorry to hear that this hasn't happened for you in the last 2 years. We have been quite vocal about fixed income, and we'll make sure that this is not something that you miss out on in the future. Uh, so let me start taking the questions. So anybody who has a question, please feel free to type it in the chat box. And let me just get through what we're seeing on the screen. So this slide indicates that yields are widening or flat. So yields are actually narrowing. So when we showed you that slide on the 2024 story, you saw the arrow which pointed downwards, right? So that shows that yields have gone from a higher level to a lower level, and the calculations that we took were peak to present, not trough, but peak to present. So what we've seen is that your yields have come down primarily in anticipation of rate cuts, just etc., etc., and like better inflation numbers and so on. Please let me know how about long-dated yield funds and 10-year bond funds. Time to continue investing or pause as a 10-year yield is below 7%. So I did talk a lot about the structural changes in terms of why your government securities yields have sort of rallied. If we look at it from a long-term perspective, right? Like that is, if you're looking at the India story over your investment lifetime, then I think your yields today are still attractive because if we continue in this path in terms of fiscal consolidation, in terms of the potential for a re-rating and an upgrade, if Indian government bonds are included on more global indices, then your yields are going to continue to get cheaper and cheaper over a period of time. But from a historic perspective, as well as near-term uncertainty, right? And by near-term, I mean anywhere in the next 3 years, you may get a re-entry at a higher level. You may not get it also. So depending on what your investment horizon is and how you are investing, I think that is one thing that you can look at. If you think this is too much, right, for you to time this, then look at a more open-ended government security scheme with a more flexible mandate. It's said that minimum bond investment required 5 to 10 lakhs. What is the alternative available to the market for small investors to avail 8 to 9% return other than mutual funds? Unfortunately, this market is like that. SEBI has been trying to bring the minimum face value of bonds down. So, but without, I think the minimum face value also, like they've made it 10,000, but the lot size is minimum. I've never seen anything below a few lakhs, right? So maybe sometimes we see a 3 lakh bond, but it's not that common. And 8 to 9% is quite challenging for you to achieve with mutual funds because mutual funds are meant to be liquid avenues. That's the main reason we also advocated for investors because a lot of them are looking to take out their money at any point without a heavy exit cost. If you get into FDs or bonds, that cost is high. You might get that liquidity, but the cost is high. So that is again one of the reasons why we advocate mutual funds. It's a lot more tax efficient. Whatever you're earning, you don't actually have to pay tax on it until you realize that gain. So There are a lot of advantages to having mutual funds in the portfolio. Are you advising us to pair some exposures to equity and move to debt? As you said, next year may be tougher. Definitely. So I think when one thing that we have been advocating for all investors to do is to sort of review their portfolios and restructure them, right? So please take a look at your total portfolio, look at how what has performed, what is likely to perform, and then restructure your portfolio. You can move money into on the asset allocation slide, we had shown you what we were positive on, what we think is a neutral call, and what we think is negative, right? So there is, I think, some scope depending on where your equity investments are. Again, selective pockets are very attractively valued. You can continue to participate there, but there are some themes and ideas which have actually run their course, and it's worth restructuring uh, those particular ideas. So for anyone who's interested in Milestones to Wealth, please do use this link to message us on WhatsApp, and we'll be happy to share more details about the program, and you can easily enroll with us. Is PG InvIT considered as a bond, and one can go for this as the yield is attractive? InvITs are not actually bonds; they are a separate entity, right? So you have like an infrastructure investment trust. So it is a listed entity. It's not like a bond, but it has certain bond-like characteristics, and you can look at the valuation and make a call as to whether you want to invest in it or not. What is your advice on corporate bond funds? Yeah, in general, we feel that all debt funds are well positioned today. Duration calls, you need to be a little bit more careful because, like I showed you, you've had a significant rally on the longer end of the curve, which means that forward returns may not be what you've seen so far, right? And so an investor needs to be a little bit more selective when they're taking a duration call. But otherwise, yes, we do think that broadly yields are attractive. Do we have any more questions that we can take? Thank you, sir. Yeah, short-term bonds are also a great opportunity. Thank you. So I've answered this question. The basic thing being that whenever you're taking a duration call, you need to be a lot more careful about it. Your yields right now are not have already rallied quite a bit. So you need to think about whether what your return expectation is and whether you can handle some volatility. So both your return expectation and investment horizon need to be clear before you're making that decision on any duration call. Right? So I think we are close to finishing our 1 hour. And I would like to thank everyone who's been here participating with us and asking questions and using this Saturday to learn something new. Thank you for joining us, and we hope to be working with you soon. Again, Gopi has shared the link to Milestones to Wealth. So if you are interested in making an investment in fixed income, if you are interested in growing your wealth to 1 crore, then please do drop us a message and enroll in our program. You can also refer a friend or a family member who would benefit from this. We're definitely doing some very good work for investors on this side. So please join us and be part of a bigger journey. And thank you once again for working with us on a Saturday.
Thank you, everyone.